Welcome back. It's Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today's topic comes from Maggie, who says, I graduated from college a year ago and am new to adulting. What guidance or recommendations do you have for savings, investment platforms, etc.? Maggie, I love your question because adulting with money is a lifelong pursuit. Everyone should keep learning and trying to improve their personal finances. However, I know being a new graduate and managing money for the first time can feel pretty overwhelming. The fact that you've asked about saving and investing tells me that you are going in the right direction. This podcast will review how a new graduate or anyone seeking solid advice can take their finances to the next level. You'll learn to prioritize your resources, create goals that guarantee financial success, and become a money adulting pro. Welcome back, everyone. Thanks for joining me. I'm Laura Adams, an award-winning author, finance spokesperson, money speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. Be sure to follow Money Girl on Apple Podcasts, Spotify, or wherever you listen to podcasts. You'll automatically get each new weekly episode. This is episode 850, which means there is a lot of Money Girl for you to explore in the archive. Be sure to follow me on Instagram at Laura D. Adams, and follow us on the Money Girl Facebook page. If you have a question you'd like me to cover on a Finance Friday show, please leave it on our voicemail at 302-364-0308. You can also send me an email and sign up for the free Money Stack newsletter when you go to lauradadams.com. All right, so let's talk about better adulting with your money. If you're a new or recent graduate, you're probably feeling a little stressed about your future and your finances right now, and that's totally normal. But I want to put your mind at ease by explaining that if you learn a few fundamental personal finance rules right now, applying them will set you up for a lifetime of financial success. It really can be easy. So we're going to go through 5 tips. They are, number 1, have an excellent bank account. One of the first things you should do after graduating is to find a great checking and savings account. It could be with a bank or a credit union or even an online investing platform. These accounts are the foundation of your money management system, so they need to offer lots of benefits like a convenient mobile app, no monthly service fees, easy transfers, bill pay, and remote check deposits. You can check out a site like Finder.com to compare some of the best FDIC-insured accounts. I'm also a huge fan of USAA. I'm a fan of Betterment. There's just a lot of good options. You want to shop around and see what makes sense for your lifestyle and your financial situation. Tip number 2. Build an emergency fund. My advice for better financial adulting is to slowly build an emergency fund using a portion of each paycheck. This is something that I did not do for way too long, and it really kept me living on the edge, financially speaking, when I was right out of school. But if you set aside, let's say, $100 a month, you'll have more than $1,000 in a year. Then you can increase your savings rate until you have at least 1 month of your expenses saved. For instance, if your typical monthly living expenses are $3,000, set a goal to save $3,000. That way, you're going to be prepared for unexpected costs like a car repair, last-minute travel, or any out-of-pocket medical bills. Ideally, you should accumulate at least 3 months of living expenses. To reach that goal, you want to consider saving 5%, maybe up to 10% of your gross or pre-tax income. Think of an emergency fund as an investment in yourself. That's how you're going to stay calm and cool in a potential crisis, like losing your job or having a car breakdown. Once you start building a cash reserve, keep it in an FDIC-insured high-interest savings account so it earns as much interest as possible. And right now, there's some great accounts out there paying over 5%. Emergency funds should never be invested because their purpose is potential short-term needs, not long-term growth. So avoid tapping your cash reserves except for a financial crisis. These funds are not for shopping. They're not for vacation. They're not for anything that you could genuinely survive without. So, no matter how much or how little money you earn, building an emergency fund is a top priority. Being a financially responsible adult means never getting caught without a healthy cash cushion to keep you safe. Tip number 3, understand how to build credit. If you're a recent graduate, you probably have little credit history, which means you likely have low credit scores. But don't worry, it's really actually easy to build good credit over time. Your credit reports, which contain the details of your credit accounts, are maintained by nationwide credit agencies. So they include Equifax, Experian, and TransUnion. The data in your credit reports is what's used to calculate various credit scores that get pulled by different lenders and merchants. High credit scores tell lenders and merchants that you've been responsible with money. Excellent credit gives you privileges like paying lower interest rates on loans and credit cards, which can save you a bundle. And low scores mean you may not qualify for credit, or you will have to pay a high interest rate if you do. In addition, your credit affects other aspects of your finances that you may not even think about, including the rates you get quoted for auto insurance, home insurance, and renter's insurance. Credit is also a factor in promotional offers that you receive and security deposits that you pay for utilities and cell phone contracts. Credit can even play a role in how some potential employers evaluate you. The easiest way to establish good credit is to pay bills on time. And if you have a credit card, making charges that you pay off in full each month is a great way to raise your credit scores slowly. Also, use about 20% of your available credit at the most. For example, if your card limit is $2,000, try not to charge more than $400. That would be 20%. And if you need to charge more than that, consider asking your card issuer for a higher credit limit, or you may want to apply for another card with a different issuer. So having more available credit in your name actually reduces your credit utilization ratio and helps your credit scores. If your credit needs to be better in order to qualify for a credit card, you can use a pre-approved secure credit card. And I'll give you a link to a really good one in the notes for the show. That's an excellent option if it reports payment information to the credit agency. So you want to make sure that that is the case. You do have to pay an upfront refundable security deposit, but the secured card works just like a regular card, and it's really a foolproof way to start building a positive credit history. After a few months, when you've shown that you're responsible, you may actually qualify for a regular unsecured credit card. Tip number 4, avoid high-rate debt. Once you have credit, it can be awfully tempting to use too much of it. I know that was the case for me when I was fresh out of school. So avoiding expensive debt is a must for good financial adulting. Debt is a powerful financial tool that can help you build wealth when used the right way. For instance, using relatively low interest debt to get an education loan so you earn more money over your lifetime, or to get a mortgage to buy a home that appreciates over time can be wise. But using high interest consumer debt, such as credit cards, to finance a lifestyle that you can't afford can be devastating to your financial life. If you're a recent graduate with student loans, understand their terms and various repayment options. For example, Stafford Federal loans give you until 6 months after graduation to start making payments, and a Perkins loan gives you a 9-month grace period. When your loan payments are due, you'll automatically be placed on the standard repayment plan. However, you can request a different repayment plan at any time. For instance, let's say you still need to find a job, or you find that your federal loan payment is too high relative to your income. In that case, you want to contact your lender to discuss your situation and investigate alternative repayment plans based on your income. And if you want to learn more about eliminating debt and creating the financial future you deserve, check out the paperback or audiobook version of my book, Debt-Free Blueprint: How to Get Out of Debt and Build a Financial Life You Love. The last tip for better adulting with your money is to start investing for retirement sooner rather than later. And you might be thinking, well, Laura, I just started working. Why should I be so worried about retirement? Well, the answer is that the earlier you start investing, the less you actually need to save to reach some pretty significant financial goals. That's because the effect of compounding, that's where you earn interest on your interest, that allows your balance to grow exponentially over a long period. But you have to put time on your side by starting early. Let's say you're a smart new graduate who signs up for your workplace 401k retirement plan and contributes $400 a month. If you never increase your contribution and you earn an average 7% return, which is pretty doable, after 40 years, you would have a nest egg worth over $1 million. That's pretty impressive considering you only contributed $192,000 of your own money. So that's $400 a month times 12 months times 40 years means you only had to pay $192,000, but your account has mushroomed into $1 million plus account. So even if you can only make a small contribution, it's better than nothing. Try to slowly raise the amount that you invest annually until you work up to 10%, up to 15% of your income ideally. If you do that for several decades or max out a retirement account for many years, it's a surefire way to set yourself up for a very comfortable future. You want to invest using tax-advantaged retirement accounts whenever possible. They reduce your taxes and may even come with free employer matching. So you don't want to miss that. But let's say your job doesn't have a retirement plan, or maybe you're self-employed. Just about everyone can contribute to a tax-advantaged individual retirement account, or IRA. You just have to have some amount of earned income to qualify for either a traditional IRA or a Roth IRA. And I've done lots of podcasts differentiating those two types of accounts. But basically, choosing a traditional IRA or a traditional workplace retirement account means you skip income taxes on your contributions and the earnings until you take withdrawals in retirement. That's when you do pay taxes on them. Having a Roth IRA or a Roth 401k or a Roth 403b means you do pay taxes on your contributions, but you get to take tax-free withdrawals in retirement, which is amazing. No matter your age, these 5 tips can help you take charge of your financial future. Also, keep learning about money by listening to the Money Girl podcast or other great podcasts, reading books, and consulting with financial professionals when needed, such as a financial planner, tax accountant, and insurance broker. Maggie, I hope that's been helpful. I really appreciate the question. Be sure to follow Money Girl on Apple Podcasts, Spotify, or wherever you listen. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. Steve Rickyberg audio engineers the show. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.